trying for. Hello and welcome to the show that gives you an insight into the most important issues of the day. You're watching The Big Picture. India's economy grew at just 5.3% in the quarter ending March 2012, according to the figures released by the government today. The rate of growth is even below the conservative estimate of 6.1% as predicted by a host of polls and predictions by economists a few days back. The manufacturing and farm sectors were the big spoilers in the January-March quarter, with growth in the manufacturing sector slowing down to 0.3%, down from 7.3% in the corresponding period last year. Farm output expanded just 1.7% during the Jan-March quarter as compared to 7.5% in 2010-11. Mining was the lone bright spot, with production growing by 4.3% compared to a meager 0.6% in the fourth quarter of 2010-11. Growth in the construction sector slowed down to 4.8%, down from 8.9% last year. The services sector stood firm, growing at 10%, the same as last year. Expert opinion, especially market voices, have expressed concern over the slowdown and have propounded that the data highlights the unusual degree of weakening in the country's economy, most likely being driven by poor investment and a widening deficit. The fiscal deficit during 2011-12 fiscal year that ended in March was at 5.2 trillion or 5.9% of the GDP. Tonight on The Big Picture, we debate whether growth in India has hit rock bottom. We will also discuss whether it's possible for the country to sustain a high growth rate without stoking inflation at the same time. And to help us deconstruct the issue, we have with me in the studio Priya Managing Editor of the Financial Chronicle, also Dr. Santosh Mehrotra, Director General of Institute of Applied Manpower, as well as Krishna Kumar, who teaches economics in Delhi University. I'd like to start the show with Dr. Mehrotra, if I could. Now, the manufacturing and farm sectors, sir, have played spoiler this time around, with the manufacturing just growing, like I said just before, 0.3% as compared to the same period last year. And the farm sector growing at just 1.7%. Did you expect such a dismal performance, or does it just reiterate the trends we've been seeing for a couple of months now?
Yeah, we've already been seeing this month-by-month trend of manufacturing coming down, so I'm not that surprised by that. But nor am I terribly dismayed by it, because I'm quite I should say that I'm quite confident about the fact that we're going to bounce back, and I think your report rightly said that we are hitting the rock bottom, and the only way we can go, only direction in which we can go is upwards.
Right, right. We'll talk about the phrase rock bottom in just a bit. I'd like to put another question to you, but before that, let me go to Mr. Dash first. Now, there is a real slowdown, especially on the consumption side, gathering from the reports and the figures we've got from the government, which consumption has been the main driver for India's growth story for some amount of years now. India was already languishing, if I could call it that, in investment demand, and now there is a pronounced slowdown in consumption as well. It doesn't really look good for the economy, does it, at this current juncture?
It doesn't look good at all. This is the 9th or the 10th quarter that you've had the deceleration or the slowdown.
A successive, I think, 8th or 9th quarter.
That's right.
Slowdown, yeah.
So that's what is very worrisome. If you look at the fourth quarter GDP is 5.3. So that's pretty worse. Worse than a 6.5 for the whole year would suggest.
Right.
Now 5.3 in the last quarter, and if the current quarter that we are in, if you look at it, things haven't really improved from whatever indicators that we can see now. Now, if just going by the arithmetic of it, it looks pretty bleak even for financial year 12-13. And with consumption now, the only ray of hope, or the silver lining, if I may say so, for 4 or 5 quarters, you've had the gross capital formation, that is roughly saying the investment rate in the economy was declining. Now the fourth quarter data, however, suggests that there is a little revival in that. That is the only silver lining, if I may say so. Otherwise, consumption trends are getting worse.
Yes.
And we've always had, for quite some time, we've had investment demand dropping.
Right.
So going into even financial year 12-13, it doesn't look good at all.
Right. Let me put a question to Krishna Kumar. Krishna Kumar, welcome to the show, first of all, once again. By and large, the blame for the underperforming of the economy seems to be coming on the centre now, the central government. New Delhi is taking the brunt of the blame now. It's inaction on the policy front, this inability to take firm steps to curb the deficit. Would you agree that the majority of the blame lies with the central government? Do you think critics of the government are correct and right when they say that the majority of the blame should be placed on the government for its inability to act on time?
No, the criticism which comes against the government, if it is with respect to saying that they're not able to rein in fiscal deficit, I do not think that is a solid critique which can be raised during times when lack of demand is something which is behind this particular problem. Because we should remember that fiscal profligacy in our country is not something which is very specific to our country. And to those particular persons who basically say that there's no governance and therefore funds is not coming, I do not know what is the sort of governance which is there in the United States which is compelling all the capital to go there.
That's a fair point.
Just a point which we have to remember is that in the context of the Eurozone crisis, which is erupting, there's a large transfer of funds towards the dollar and there's an appreciation of dollar. And as a result of that, you're basically having lots of currencies boiled by depreciating. There's a serious issue in the international economy per se. India has voted in favor of reform in the course of 1990s, thinking that there is markets out there for us to tap and we would be able to complement or we would be able to substitute that markets abroad instead of the domestic market. But now the situation is that that market is bleak worldwide, be it United States or for that matter, be it European Union, which are major trading partners. So is the government able to substitute that lack of demand by proper fiscal stimulus within the country, say in the form of capital expenditure on major programs? While we say that we try to emulate China on different fronts, number of capital expenditure projects have been put forward by China in the course of the last 2-3 years. Indeed, to see to with that, they're able to tide over this sorts of, they're able to tide over to a limited extent the setback as a result of the global recession. So are we able to put on block certain things? Or are we waiting for the market to do the trick and increase the levels of investment ratios in our country, which is not going to occur during a time when, because certain corporates, at least the richer corporates in our country, are awash with funds and they are not spending. And the small and medium enterprises are looking forward for funds and they are going to be the victims of monetary tightening in the name of inflation. So in fact, I also feel that we have hit a ceiling, and we have to basically now think in terms of what are the limits of this external market-led growth? Is there a limit of that?
Let me get Dr. Mehrotra in on this. Do you agree with Krishna Kumar, first of all, and do you also agree that largely placing the blame on the central government and its so-called inability to usher in reforms, is that fair at all? Putting all the blame largely on the government?
Well, let's recognize the following fact, that the growth rate is lower this year than ever before in the last 8 or 9 years. However, there's a converse to that. Between 2003-04 and 2011-12, the growth rate has averaged 8.2% per annum. We are still the second fastest growing economy in the world after China. So let's just keep
we're not that far. We're not that far. They have 8% revised growth rate. We have about 7 to 7.5% projected.
Right. And I'm telling you that over this entire period of 8 to 9 years, we've averaged 8.2%. That's not bad going, considering what is happening in Europe and North America.
True.
Now, I'm not one of those who's sort of going to play the blame game. Certainly, there are policy levers that are available with the government right now, which are going to start the upswing, and I can name some of them. It's perfectly possible that in the monsoon session, we will finally now, the government, because this data will serve as a wake-up call, a very big wake-up call, and in the monsoon session, we will get the big reform bills, meaning the pension, the banking, the insurance bills will probably go through because there's bipartisan support across the aisles on this. So that will go through. Retail FDI will come through. You will probably see as a result of this that RBI is going to reduce rates, interest rates on June the 18th. So you're going to see a slew of action which is actually going to sort of turn animal spirits around of the capitalists.
We'll take a small break right here, gentlemen. We'll come back and I want to ask Mr. Dash about the rock bottom philosophy. I'll come to that after the short break. Don't go anywhere. Lots more to come on The Big Picture. Stay tuned. Welcome back. You're still watching The Big Picture. Mr. Dash, if I could ask you this. I'll give you a bunch of numbers right now to just digest now. GDP growth slipping to around 5.3%. It's just a latest in a string of bad economic news we've got. That also includes a current account deficit hovering around 4% of the GDP, fiscal deficit of around 5.8, 5.9%, around that much, a trade deficit of 9.9%, inflation at 7.23%. Not good news for anyone. Merrill Lynch and a couple of other international banks have downgraded their projections for India. They used to be somewhere around 7 and above 7. Now it's under 6. Another piece of bad news for India now. Would you say that India, like we discussed before, has it hit rock bottom? Or would you agree when some people say that India has found a new rock bottom beyond the first rock bottom we found? Do you think we can sink even lower?
It could be worse. It could be worse, actually. Because you see, look at the fiscal deficit is one thing that you mentioned as a bad news, but there is some good news or bad news as you look at it. I mean, today, that last year fiscal deficit instead as a proportion of GDP, instead of being 5.9%, which was the earlier estimate, is now 5.7%.
Right.
Now, since growth has dropped to 6.5. It was earlier estimated at 6.9%. So on a lower GDP, you have a lower deficit. That means that the fiscal deficit wasn't as bad as it was being considered to be. Now, one of the factors, like Mr. Krishna Kumar was mentioning, I quite agree with him, that in fact, it is government's inability to spend or invest. Let's put it, it's spending money on subsidies and things like that, but it's not really investing money in productive activity, is a primary reason as to why growth is down. Because particularly if you look at the services sector, where we've had a stellar performance and a more consistent performance of around 10% last year meaning the previous year, it was 9.7. And in fiscal year 2011-12, it is down to 7.3. Now, that has happened because services sector has two parts. One is the government sector, basically the community, social services, health, education and things like that. And one is the private sector. Now, there is the government sector is depressed. So that's a very serious thing if you're trying to revive the growth, right? And coming back to a question about rock bottom, that is another problem, because the government is trying to bring about a fiscal consolidation, which is rather lopsided. No concrete action is being seen on the fronts that is promised. For instance, the finance minister has promised in the budget to keep the subsidies limited to 2% of GDP. Yeah. Nothing much has happened. 2 months are going, in this financial year. Whereas in things like where productive investment could be done, things are depressed and bad, and that is what is inducing a low growth rate.
Let me just interrupt you for 1 second, go to Krishna Kumar and ask you. Since we're talking about subsidies and fiscal consolidation, let me ask you this. The surging CAD now, the current account deficit, it's the highest since 1980. According to some figures now. That essentially cuts any scope for RBI to ease rates further. It completely ties their hands. We don't really expect them to in their June 18th meeting. Now, do you see, if there is no scope for further fiscal stimulus to industry, how can one expect to revive industry without stoking inflation? Is that possible at all?
The current account deficit of 4% of the GDP is unprecedented also. You should remember that the current account deficit increases in our country when manufacturing growth increases within the country. That's an automatic relation. But now we are having manufacturing growth at a very low level of 0.6%. And at the same time, you're basically having current account deficit at very high levels. Partially, it is being rationalized by saying that some amount is due to gold import. But nonetheless, if you avoid that also, you find that the current account deficit is there to stay. And this current account deficit, the attempt which is now being portrayed by certain optimistic corners is that you are basically having nominal depreciation of currency, and as a result of the nominal depreciation of currency, you will have export competitiveness increasing. I really doubt whether that's going to happen, because if you take the real exchange rate of the currency, it has actually appreciated, given that deflation or low levels of prices are prevalent elsewhere in the world as against higher levels of prices within our country. We say that the currency is, in fact, if you compare to 2000, though there has been nominal exchange rate depreciation, there has been real exchange rate appreciation.
Right.
So logically speaking, competitiveness, whether that is going to come from there, is a, so I really feel even now that what saved us in the 2007-8 gap, that is during that particular period for 2 to 3 years, was something like the pay commission plus the NREGA plus different other flagship programs of the government, which has now lost steam. And now what is happening
and
is
perhaps reduction as well.
Perhaps reduction as well.
Right.
And you also at the same time have the external market, the cushion of the external market, which was there for us, not being there.
Right, right.
And country after country is now going into that interwar year sort of a situation where people are raising tariffs or resorting to protective measures. To what extent we would be able to cater to manufacturing employment? Dr. Mehrotra was mentioning about manufacturing growth. You know, the importance of it in the current period has to be noticed, that you have extremely low employment intensity of manufacturing.
Since you mentioned, Krishna,
so
since you mentioned the currency as well, the currency depreciating, let me ask Dr. Mehrotra this. The rupee, 14% fall in 2012 obviously added to inflationary pressures, but it's not just the rupee that's slowing down the economy, is it? There are other red flags as well that people have pointed out. The current account deficit, for example, subsidies, for example. It's not just the rupee that's hurting us, is it?
Well, I began by saying that what happens in the real economy is what slows the economy, meaning it's manufacturing which has not grown fast and it's in fact it's slowed down very. The other point that needs to be remembered is that there is indeed, unlike in 2008 when we last had a financial and economic crisis globally, and we are in a global crisis again, the Eurozone situation being what it is, we have less fiscal policy space today than we had then. I recognize that fully. Yet at the same time, I would hazard a guess to say the following, that I do not, unlike my two colleagues, subscribe to the gloom and doom that in a sense that they've been talking about for the following reasons. It could become worse from this point onwards only if the reforms that I was talking about are not put in place, and frankly I don't see any reason why the reforms will not come now, and secondly if the interest rates do not decline, and I expect interest rates to decline because fiscal consolidation is very much on its way, and at the same time inflation rates have declined. So in other words, if the RBI was to reduce interest rates at this point, please remember that the savings rates to GDP ratio are still very robust. They've never over this entire 10-year period that we've been, the past 10 years, has it fallen below 32% of GDP, and even now it isn't. So in other words, the savings are there. If the interest rates fall, you know, we will get to see investments and growth will resume. That's really what my argument is.
We'll let Krishna Kumar respond to that, but just one question I want to add before you respond to that. Do you see the RBI easing rates on June 18th? Do you think it's going to happen at all? Do you see any chance of that?
The reason why I'm indicating that it may well happen is precisely because of the numbers that we are discussing today, meaning growth rate has really fallen below. I don't recall this a quarterly growth rate which was as low as this even post 2008 crisis. So you know that's a sense in which I'm talking about having hit rock bottom. And because fiscal consolidation is on its way, I mean, please remember that if growth resumes, it will help fiscal consolidation because revenues will rise. Government's revenues will rise. So that's really the point I'm making, and the savings are there for investment to resume.
Fair point. Point taken, sir. Let's let Krishna Kumar respond to that briefly, sir. If you could, we have to take another break.
No, the point which I would like to, this is in fact a proper dissent only. Because the whole argument that a set of reform bills, particularly the PFRDA bill, the insurance bill, etc. is passed, and therefore we will again become the darling of the foreign capital, and therefore capital will flow inside, and therefore a capital inflows-led liberation of the Indian economy or an integration of the Indian economy would occur.
That's not what I was suggesting.
No, what would happen in this particular regard is this, that if we go for this sort of ad hoc policy measures, now that we want to please the foreign capital, we want them inside. Remember in 2003 when the Indian rupee appreciated, that at that time the government said, the private corporates that you go and hunt for investment opportunities abroad, undertake investment opportunities abroad. And they did not even hedge against a plausible depreciation of rupee in the long run. That some of them, the balance sheets have gone broke. So you can't have one set of policies being pursued when there is an appreciation spree and another set of policies being pursued when there is a depreciation spree. And this is some sort of a trap in which different developing countries, when they are characterized by cyclicity of capital flows, they all become exposed to. And in fact, that would not be much in the larger interest
Hold that
of the
thought,
economy.
Krishna Kumar. We'll come back to that point after the short break. Don't go anywhere. The last segment of the show is still to come. We'll still be discussing closing arguments from all my three guests. Stay tuned. Welcome back. You're still watching The Big Picture, and let me go straight to Mr. Dash first. Mr. Dash, we talked about FDI in retail. Perhaps Dr. Mehrotra said could come in the monsoon session. And of course, Mr. Kaushik Basu has also been saying it is one of the biggest weapons we could have against inflation. Do you see FDI in retail? Do you think it must be brought back, must be ushered in, that one particular reform, so that we can at least attack inflation and perhaps get somewhere with it? Do you think it's going to happen, and do you think it should happen?
Well, the finance minister today has said that all that is necessary to boost growth, the government will take. Now, all these bills that we are talking about, he said in his budget that he will get them passed in the budget session. If there is bipartisan support for all these bills, were these bills not passed in the first place? So there is a political problem there. And those political problems the government has to sort out before it can make any advance on any of the reforms measures that we are talking about. After all, we know that the retail issue was the government did it, but it had to withdraw it. So these are very sensitive political issues and very controversial political issues. The government has to show leadership in doing this.
Right.
One thing, however, that Dr. Mehrotra mentioned, and that if we as a nation recognize that we are in the midst of a crisis, maybe we'll be nudged into taking action that is required to be taken. But when the government itself keeps pretending that we are in no crisis, that we are still aiming at 6.5% growth and we can easily overcome things, then it is giving away the game. See, that is my only, otherwise, as you mentioned in your opening statement, look at any indicators. And I do not see why and how things would be reversed.
Right.
Government is not investing, private sector is not investing. The savings rates have been good. That is the household savings. But the households have been investing in physical assets of gold, and that is why you landed up with a gold import bill of 68 billion and a current account deficit of what you have had.
Let me come very quickly to Dr. Mehrotra and ask him this. Do you see, sir, a silver lining here as well? Despite the fact that this quarter's GDP growth is 5.3%, much less than what we had anticipated, if you compare our growth with, say, Europe, the Eurozone and the US, we're still better off. Us, China, the BRICS countries, so to say. China is growing at 8%. We have a projection, like I said before, 7 to 7.5%. Do you see a silver lining here somewhere, saying that comparatively, compared to the rest of the world, even if there's an economic slowdown, we have it slightly better off than the others?
I told you the numbers on this early on, that we've been growing at 8.2% per annum on average between 2003-04 and 2011-12. So that sort of goes without saying, just to reinforce that. But I just want to sort of pick up on a point that Mr. Krishna Kumar found fault with in regard to what I was saying earlier. I'm not arguing that FDI will flow in because of policy reforms happening. FDI inflows are pretty robust. They have been pretty robust over the course of the last few years. It's only and even FII's inflows were pretty robust even in the first quarter of the year. So the point I'm making is that when policy reform process begins, then domestic investment will begin to take off, because domestic investors have this sense that there is a policy paralysis, and the sense of policy paralysis will go away if reforms begin to be introduced. That's the point I'm making.
Right.
So that's the silver lining. Now, if that does, and I agree with my colleagues that if none of the policy reforms happen, interest rates don't come down, then it's true that we have not hit rock bottom. The sense of policy paralysis must go away.
But you have a sense that interest rates might just ease in June as well.
Well, if they don't ease in June, they will begin to ease very soon thereafter, for the reasons that I was explaining earlier. Look, the Reserve Bank governor has been saying the reason why he's not being able to reduce rates is because, you know, fiscal deficits are very, very high. And if he does that as well, then private sector borrowing will take off, as it is government borrowing. Is that? But I'm saying that fiscal consolidation is really being set in motion. And after all, the petrol price is also being increased. Hopefully, it will not be rolled back. So that's the reason why I'm somewhat hopeful. That's the silver lining that I'm seeing, that interest rates might actually come in for that reason.
Last word on the show, Krishna Kumar. We have very little time, Mr. Dash. Do you agree with Dr. Mehrotra? Do you share his optimism? And how do you see the next couple of months panning out, say at least till June 18th, when the RBI meets again?
I really think that the policy paralysis of which Dr. Mehrotra has said about, I really think such sort of measures, ad hoc measures from the part of the government, measures led by certain legislations and so on, I feel in its place, in case if probably the government can really think in terms of boosting up capital expenditure through some steps, because rather than saying that let us try to lure in private capital and try to do the business, because the situation is now not conducive for it. At least let us take stock of the fact that towards triggering what we all characterize as Keynes's animal spirits, we require proper pump priming of the economy through capital expenditure infusion. Whether the government can do that in a less inflationary manner is the
It remains to be seen. That's all the time we have today. Thank you, gentlemen, for joining us. Joining me in the studio today, Dr. Mehrotra, Mr. Dash, Krishna Kumar, of course. All might not be lost yet. We probably hit rock bottom, and that can only be good because we can't go any lower. The next couple of months will tell us whether the RBI will ease rates or not. Dr. Mehrotra seems to think that there is a case that they might just cut rates a little more, but we'll have to say and wait till June 18th for that to happen. Thank you so much for watching tonight. From all of us in the studio, that's it. From us, good night, and thank you for watching.